When ordinary people hear the word war, they think about missiles, maps, and headlines. I think about something more immediate. I think about the family that wakes up to higher gasoline prices, the small business owner whose shipping bill suddenly jumps, the retiree who watches a portfolio swing for reasons that have nothing to do with the quality of the businesses inside it. That is why moments like this are so dangerous. They do not stay on the battlefield. They move quietly into kitchens, paychecks, pension funds, freight routes, insurance costs, and the state of mind of every investor trying to act rationally while the world grows emotional. Most people believe the greatest risk in a crisis is the event itself. In my experience, the greater risk is what fear does to human judgment. When people feel cornered, they stop valuing businesses and start reacting to noise. They confuse motion with wisdom. They mistake panic for prudence. And when a conflict touches energy, shipping, currencies, interest rates, and consumer confidence all at once, the market becomes a mirror of human emotion before it becomes a weighing machine again. That is where wealth is often damaged, not by the headline alone, but by the decision made in response to it. I have lived long enough to see markets shaken by war, oil shocks, inflation scares, political shocks, and moments when the future looked far more fragile than people wanted to admit. The pattern is familiar. First comes the shock. Then comes the scramble to explain everything in one sentence. Then comes the urge to sell what is good along with what is bad, simply because uncertainty feels unbearable. But uncertainty has always been the admission price for long-term investing. The real question is not whether the world feels dangerous today. The real question is whether you will allow danger to change your standards, your temperament, and your discipline. Right now, the reason investors are so sensitive is simple. This conflict has put enormous attention on the Strait of Hormuz, a route that normally carries about 1/5 of the world's oil and liquefied natural gas flows. Reports this week said the war had already caused one of the largest supply disruptions on record, while oil prices swung sharply as markets reacted to both military escalation and ceasefire rumors. On March 24 and 25, crude dropped after reports of a U.S. proposal to Iran raised hopes of de-escalation, even though fighting and official denials continued. Now think about what that means in plain English. If energy routes become uncertain, fuel becomes more expensive, transportation becomes more expensive, manufacturing becomes more expensive, food becomes more expensive, and suddenly central banks have a harder job. A war that appears distant can end up sitting in the price of groceries, airline tickets, building materials, fertilizer, and consumer goods. Reuters reported that analysts were openly warning about recession risk if oil were to stay elevated or spike much higher. And business surveys in the United States were already showing slower activity as higher energy costs fed inflation worries. This is the part many investors miss. They think oil is only about oil companies. It is not. It reaches into airlines, trucking, chemicals, agriculture, packaging, retail margins, industrial inputs, and household budgets. Higher energy costs can squeeze consumers from one side and businesses from the other. And when that happens, weak companies suffer first, over-leveraged companies suffer next, and even good companies may be punished temporarily because the market starts pricing in slower demand, narrower margins, or stickier inflation. In other words, war pressure can spread across sectors in waves, even when the missiles are falling in only one region. Gold, bonds, and the dollar often become emotional shelters in moments like this. But even those moves tell a more complicated story than people assume. On March 25, gold rose sharply while bond yields fell, and the dollar strengthened as investors weighed the chance of de-escalation against the reality that inflation and growth risks were still alive. Stocks also bounced on ceasefire hopes, especially in areas that benefit from lower fuel prices, while some energy names fell back as crude eased. That tells you something important. Markets are not only pricing what is happening, They are constantly repricing what might happen next. When I study human behavior, I notice that people are comfortable with risk when it is hidden and terrified of risk when it is visible. Yet the stock market has always contained uncertainty. A conflict like this simply puts uncertainty on television. Suddenly everyone feels compelled to do something. They refresh prices more often. They search for predictions. They look for the smartest sounding voice in the room. But the investor who survives these moments is usually the one who asks a quieter question. Has the earning power of the business changed permanently, or has the mood of the market changed temporarily? That distinction matters more than ever when politics and war enter the conversation. Political leaders make statements for many reasons. Markets react in seconds, but businesses live in years. If you let every political development reorder your entire portfolio, you are no longer investing. You are volunteering to become a hostage to events you cannot control. This week alone, markets swung from fear of a prolonged energy shock to hope around a reported 5-point ceasefire proposal, while Iranian officials publicly rejected negotiation claims and fighting continued. That is exactly the kind of environment where emotional investors can be thrown back and forth like a leaf in the wind. So what should a thoughtful investor actually do in a moment like this? First, separate the world into buckets. There are businesses directly helped by higher oil, businesses directly hurt by higher oil, and businesses whose long-term economics remain largely intact despite the panic. Second, study balance sheets. In a period of war-driven volatility, debt becomes more dangerous, refinancing becomes more expensive, and fragile companies lose room to breathe. Third, remember that cash flow and pricing power matter more than exciting stories. When costs rise suddenly, the companies that can protect margins without destroying demand usually come through stronger than the rest. I also want you to notice something deeper. The damage from war is not only financial, it is psychological. It teaches people to think in shorter and shorter time frames. It makes them impatient, tribal, and reactive. It encourages moral certainty and financial recklessness at the same time. That is a terrible combination for decision making. When a person is angry, afraid, and overexposed, he becomes easy to separate from his money. He stops asking what something is worth and starts asking whether he can stand another bad week. That is not analysis. That is pain management disguised as strategy. If I were speaking plainly to any leader involved in a conflict that carries this much economic risk, I would say this. The cost of escalation does not end with military budgets or diplomatic statements. It travels through energy arteries, trade routes, inflation expectations, capital markets, and the confidence that holds commercial society together. When one of the world's most important shipping corridors is threatened, the burden is carried not just by governments, but by workers, families, importers, savers, and pensioners everywhere. That is why a dangerous war is never only a foreign policy issue. It becomes a tax on the ordinary person. And if I were speaking plainly to the investor at home, I would say something just as direct. Do not let a frightening world turn you into a foolish owner. Bad times reveal whether you truly understand what you own. They reveal whether your portfolio was built on conviction or convenience. They reveal whether your patience was real or merely borrowed from a rising market. Anyone can feel calm when prices drift upward and oil is stable. The test comes when the map turns red, the headlines turn urgent, and the market demands an emotional response every hour. My advice is not dramatic. It is disciplined. Do less reacting and more thinking. Review your holdings one by one. Ask which businesses can survive inflationary pressure, disrupted logistics, nervous consumers, and tighter financial conditions. Ask which management teams have seen trouble before and behaved intelligently through it. Ask whether your position sizes were built for volatility or merely for optimism. In times like this, the investor with a clear framework is not fearless. He is simply less available to panic. The world does not become safer because markets bounce for a day. And it does not become uninvestable because fear spikes for a week, wisdom lives in the middle. You acknowledge the danger without surrendering to it. You respect the economic chain reaction without assuming every business is broken. You understand that war can shake pricing, sentiment, and policy, while also remembering that strong enterprises, honest management, and patient capital still matter. That is where I would begin. Not with panic, not with prediction, with clarity. Now let me take you a little deeper, because this is where serious investors separate themselves from emotional spectators. In a conflict involving the United States, Israel, and Iran, the market does not move in a straight line. It moves in layers. First comes fear, then comes repricing, then comes realization. Fear hits quickly, repricing follows as money rotates between sectors, and realization comes later when investors begin to see which effects are temporary and which ones are more lasting. The energy sector is usually the first place people look, and that makes sense. When supply routes feel threatened, oil and gas prices can rise, and energy producers may benefit for a while, but a smart investor still needs to be careful. A rising commodity price can make a weak company look strong for a short period. That does not make it a great business. I would still ask the same questions I always ask. Is the balance sheet solid? Is management disciplined? Can the business survive a full cycle, not just one lucky quarter? Then you move to transportation, airlines, shipping firms, freight companies, and manufacturers feel fuel costs very quickly. When energy prices jump, margins can shrink fast, especially if those businesses cannot pass the extra cost to customers. This is where hard times reveal the truth. In easy markets, inefficiency can hide. In difficult markets, it gets exposed. Investors suddenly learn that not all revenue is equal and not all growth is valuable. Consumer businesses feel the pressure in quieter ways. When families spend more on gasoline, utilities, and food, they usually become more careful everywhere else. They delay purchases, cut back on extras, and focus on essentials that can hurt travel, luxury dining, electronics, and many discretionary brands. A war-driven inflation shock often moves slowly through consumer behavior, but it moves. The damage is not always dramatic at first, yet it can be very real. Financial companies face another kind of test. Banks, insurers, lenders, and asset managers depend on confidence, liquidity, and credit quality. If war adds inflation pressure and uncertainty, lending can slow, defaults can rise, and risk premiums can widen. Strong institutions with conservative standards may hold up well. Weaker ones, built on aggressive assumptions, may quickly look fragile. In moments like this, the difference between prudence and optimism becomes very clear. Technology is not as protected as many people think. Even strong tech businesses can face supply chain strain, export restrictions, cybersecurity risk, weaker business spending, or lower advertising budgets if the economy slows. Great companies can still remain great, but they are not immune to short-term market pressure. In a fearful market, people often sell what they can, not only what they should. Defense companies also attract attention in these moments. That is understandable. Tension can lead to higher defense spending and stronger interest in aerospace and security names. But I would still be careful. A company does not become attractive just because its industry becomes more visible. Visibility is not value. When fear sends money into a theme too quickly, prices can move ahead of reality. The investor who refuses to overpay protects his judgment. This is also why diversification matters. Real diversification is not owning random stocks. That means owning businesses with different cost structures, different demand drivers, and different kinds of risk. In a war shock, many stocks may fall together for a while, but their actual economics are not the same. Some are only marked down because the market is scared. Others deserve to fall because their future earning power is weaker. The job is learning the difference. There is another danger here that has nothing to do with oil or missiles. It is narrative addiction. During a crisis, people become desperate for one simple story that explains everything. They want certainty disguised as analysis. They want one headline, one villain, one answer, and one trade. But markets do not reward drama the way social media does. They reward sober thinking. When an investor becomes addicted to narrative, he stops weighing probabilities and starts chasing excitement. I have seen many people lose money, not because they were unintelligent, but because they were overstimulated. They watched too much, traded too quickly, and confused urgency with wisdom. That is why temperament matters so much. In a war-driven market, emotional control becomes part of your advantage. If you can stay steady while others feel compelled to react, you gain something valuable. You gain the ability to compare price with value while others are comparing headlines with each other. This is the mindset shift I want you to keep. Do not ask, what should I do because the world is scary? Ask instead, what kind of owner do I want to be when the world is scary? The first question invites impulse. The second invites character. Markets eventually reward the investor who behaves like the owner of a productive asset, not a collector of flashing prices. And crises have a way of exposing who has truly built that mindset. If you own strong businesses with durable demand, capable managers, sensible debt, and products people will still need years from now, volatility becomes something to study, not automatically something to fear. That does not mean risk disappears. It means you classify it correctly. A temporary price decline is not the same as permanent capital destruction. A frightening week is not the same as a broken business. So when people ask me what war means for investors, my honest answer is this. It means more uncertainty, more emotional pricing, greater importance of balance sheets, and a much harder test of patience. It means weak assumptions get punished. It means leverage becomes more dangerous. It means pricing power matters more. And above all, it means the calm investor has a better chance to think while everyone else is reacting. When leaders refuse restraint, the world pays a price. When investors refuse discipline, they often pay twice. That is why I would urge caution and character now. A dangerous world does not reduce the need for patience, it increases it. It does not make wisdom less useful. It makes wisdom more necessary than ever.